Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Barry Larking, Special Counsel at the IBFD, and with me for our Beyond the News interview is Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. On today's show, EU finance ministers have given their final approval to reporting rules for digital platforms, but there's time to get ready. The UK is looking at wide-scale tax reforms that include more digitalised tax administration, tougher tax avoidance measures, and various environmental tax changes. And Russia is proposing significant tax hikes for individuals, at least for the rich ones. These and more, including Stuart Gibson's Beyond the News interview with Renata Emery, partner and head of the tax practice at Tozzini Freire in Sao Paulo, Brazil, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week as reported in IBFD's Tax News Service. Last week, we reported that the European Parliament had approved new reporting and information exchange rules for online platforms, known as DAC 7. 1 week later, we can report that EU finance ministers have given their seal of approval to the new rules that will require digital platform operators to report income earned by sellers using their platforms. And member states will then exchange this information amongst themselves. The new rules are due to kick in generally from 2023. A less publicised aspect of the new rules is that they include some general improvements to the current tax assistance framework in the EU, including rules for conducting joint audits. Germany's Ministry of Finance has issued guidance on how the German-controlled foreign company rules apply to non-EU countries. The good news is that the German tax authorities now apply the so-called substance carve-out to controlled companies in third countries as well as those in the EU, in line with earlier German court decisions. The perhaps not so good news is that a complex set of conditions must be satisfied before the carve-out will apply in practice. In particular, the guidance indicates that taxpayers must show not only that there is sufficient economic substance in the foreign company, but also that the structure was not primarily tax motivated to be able to avoid the German CFC rules. Germany is also considering some general reforms to its corporate tax rules, including giving partnerships the right to choose corporate tax status and to remove the current exit tax on German companies that transfer their residence to non-EU countries. The proposals are contained in draft legislation now going through the German Parliament. The UK is also looking at possible tax reforms, according to a budget announcement last week. The reforms aim to improve how taxes are administered, deal more effectively with tax avoidance and evasion, and modernise a whole range of existing tax rules. Not surprisingly, digitalisation is the main focus for improving tax administration. The reforms would also apply tougher rules to promoters of tax avoidance schemes, while offshore tax evaders will find it more difficult to hide. And possible areas for modernisation include various environmental taxes, transfer pricing documentation, and certain VAT rules. Last November, Indonesia made some fundamental changes to its tax system by exempting various types of foreign income from taxation. The Indonesian Ministry of Finance has now provided detailed guidance on how to apply these exemptions. For foreign citizens that become tax resident in Indonesia, the new rules mean that the foreign income will not be taxed for the first 4 years, and the guidance addresses the conditions for qualifying and how the 4-year period applies. The new rules also exempt dividends and foreign profits from taxation if the taxpayer invests the income in Indonesia, and the guidance clarifies how that investment should take place. Last year's law also provided for a reduction in the withholding tax rate on interest paid to non-residents. The new rate that will take effect later this year has now been fixed at 10% instead of the current 20%. And now moving on to other news. At the end of last year, Russia introduced a 2-tier progressive tax system with a top rate of just 15% for incomes above around €50,000. Well, just 3 months later, it seems the Russian government has decided that the system was not progressive enough and is now proposing 2 extra rates with a top rate of 35% on incomes above around €1 million. Who knows, maybe this will now prompt French actor and tax exile Gérard Depardieu to surrender his Russian passport and return to Paris. As countries around the world, including the United States, continue to postpone tax filing and payment deadlines in response to the ongoing pandemic, US states are granting similar extensions. For the latest developments, check out the IBFD's Tax News Service. There's some good news for US taxpayers who report their foreign bank accounts late. A US district court has ruled that the civil penalty for non-willful late reporting of foreign accounts applies for each annual report and not for each account. The taxpayer in this case had 4 accounts, but the ruling limited his liability to $10,000 instead of the $40,000 that the government demanded. But it's another story for taxpayers who willfully or recklessly disregard their reporting obligations. Last week, a federal court of appeals upheld an IRS penalty equal to 50% of the value of the account in question. And finally, it seems that despite Brexit, the UK has not fully escaped from its EU nightmare, as the European Commission recently demonstrated when it ordered the UK to pay back up to €100 million in illegal state aid. Ironically, the aid was not even granted by the UK as such, but instead by Gibraltar, a territory that is sometimes assimilated with the UK under EU law. The disputed aid concerns Gibraltar's former rules for exempting certain interests and royalty receipts. Yet another example of you can run, but you can't hide. Now we go beyond the news for Stuart Gibson's interview with Renata Emery. Stuart.
Thank you, Barry, for your informative news report. I'm Stuart Gibson, Chief Editor of Global News here at IBFD. Joining me today is Renata Emery, Partner and Head of the Tax Practice at Tosini Freire in Sao Paulo, Brazil. Welcome, Renata.
Thank you, Stuart. It's a pleasure being here with you and IBDF audience today.
Wonderful. Before we dive headfirst into the swirling political waters of Brazilian tax reform, Renata, could you please briefly tell our viewers about your practice?
I'm a tax practitioner in Brazil for more than 20 years, and I deal with consultancy and tax litigation at both administrative and judicial levels.
Sounds like you cover the whole range of taxes in Brazil. So we're here to talk about Brazilian tax reform, but we don't have 2 days for our conversation or even 2 hours. So let's talk about the current system. You've worked within the Brazilian tax system for more than 20 years, and it would appear to the outside observer that the 3 biggest issues with the current system are, in no particular order, complexity, uncertainty, and lack of conformity with some international norms like those established by the OECD or Brazil's counterparts within the G20. What do you see as the biggest challenges that businesses face under the current system in Brazil?
You are totally right, Stuart. To point out the complexity and the uncertainty of our tax system as the biggest challenges that business face in Brazil. Since Brazilian Constitution grants tax powers to the 3 governmental levels, the federal, the state, and the municipal, there is a huge overlap, at least on consumption taxes in Brazil. For instance, states levy state VAT on the sales of goods, and municipalities levy a tax on the sales of services, which in many cases can raise conflicts, especially when taxpayers deal with mixed activities. And to add a little more of confusion into this scenario, there are 26 states in Brazil and a federal district, and more than 5,000 cities, all with lawmaking powers. So you can imagine the complexity of a system where more than 5,000 cities and 26 states can legislate on their taxes. There's also tax war among states and municipalities to attract investments. And on the top of that, there are also some federal taxes on industrialized products and turnover taxes. As a result of this complex system, there is a lot of uncertainty, and which generates tax litigation. On the top of that, consumption taxes have a heavy weight on people's expenses, which ultimately generates inequality and unfairness since poor people pay the same taxes as rich people. This is just to mention some of the few issues we have in our tax system, not mentioning direct taxation.
So from your description, particularly when it comes to consumption taxes, it appears that Brazil is facing similar challenges to the ones that India tackled a few years ago when that country adopted a national GST. Do you think Brazil could use the Indian reforms as a model for its own reforms?
Tax practitioners often refer to the Indian reform as a role model for us because we face similar challenges in Brazil due to our political division. The Brazilian tax reform currently under discussion focuses on the consumption taxes, and the main goal is to consolidate all these taxes into one single VAT.
So that's what India has done, and that seems to have worked out. So I want to get to the meat of Brazilian tax reform, and I liken it to an expression we have in the United States. Everyone talks about the weather, but no one does anything about it. When we talked about this a few weeks ago when we were planning for this interview, it looked like tax reform was ripe for action. But things have changed over the last few weeks, and the climate appears to have soured. So could you talk to us about why things have changed and when we might expect to see national tax reform in Brazil?
When we talked a few weeks ago, both the presidents of the Senate and the House of Deputies have been recently elected in Brazil, and they are both supporters of our president, Jair Bolsonaro. However, since the pandemic grew worse in Brazil, there is now a different political environment, and it seems that a tax reform is far away. So if the tax reform is not passed this year, which seems unlikely, it won't be passed the next year because we will have presidential elections in 2022. So it doesn't seem that we will have tax reform passed with Jair Bolsonaro, but most probably with the next president.
So it sounds to me like the Brazilian politics is very similar to US politics. No one wants to tackle tax issues during an election year. And so the question really comes up then, does this foreclose all tax reform, or is there, even though it's unlikely we'll see tax reform at the national level in Brazil anytime soon, do you see opportunities for states and municipalities, which, as you described, are in competition with each other? We see tax competition within the 26 states and the federal district and the 5,000 plus municipalities. Do you see an opportunity for the states or the localities to enact some tax reforms that might address some of the problems in the current system?
You're right, Stuart. There's definitely some opportunity to pass some smaller reforms at state and municipal levels. In fact, there is one proposal which is supported by several entities, and it's called Simplify Now, which would introduce less dramatic changes to our tax landscape. And it seems that this proposal has now more chances to be passed in the Congress.
So the Simplify Now would be national legislation that would simplify the state and municipality VAT regimes?
It would unify the legislation of the state value-added tax and the service tax. And it would also simplify accessory obligations.
I see. So would that ease the administrative burdens of compliance then for individuals and businesses that have to comply with maybe 100 or 200 different regimes where they do business?
Yes, you're right. That's it.
So one of the challenges of the current system is every state has its own forms, I assume, and every locality may have its own reporting forms and their own formats for reporting information. And how you pay and how you register. So is the Simplify Now proposal, is it directed at a lot of the administrative burdens of compliance then?
Yes, it aims to unify all these burdens and simplify these burdens, as well as have a legislation at national level.
So you mentioned that it looks like we will not see any extensive overhaul of the Brazilian system until after the next presidential election in 2022. Is it likely we will see this Simplify Now proposal? Does that have a chance of passing before then?
It has a chance of passing before that, and there could also be some other smaller changes, as I mentioned, at state and municipal levels. But that would depend on the lawmaking powers of each state and municipality. That is more likely to occur than the current proposals to introduce national VAT.
So it sounds from what you've shared with us today, Renata, that hope springs eternal. That we may see some reforms before the next election, and then we may see more extensive reforms after the next election. Did I get that right?
That's my feeling.
Oh, very good. So it's a lot more encouraging than I thought. So our guest today has been Renata Emery, partner and head of the tax practice at Tosini Freire in Sao Paulo, Brazil. Thank you so much, Renata, for your time and for sharing your valuable insights on a very, very important and timely issue.
Thank you, Stuart. It's a pleasure talking to you and IBDF.
Just a quick programming note, we will not be producing a tax takes video next week, coinciding with the Easter weekend holiday in the Netherlands. We will return in 2 weeks, however, with a new show and a new guest. We're going to be talking about cyber currency and virtual currency. That wraps up this week's edition of Tax Takes News and Views, the week's tax news in a nutshell. From Barry Larking and myself, thank you for watching. Here's hoping your week is not too taxing.